Okay guys, so I'm going to try to do my best to describe this new trading technique I've been reading about. It's called naked trading. The idea is basically just trading looking at the chart candlesticks on its own. No extra indicators on top to show you anything. Indicators are there to just show you impulses that go up and down so you know when to buy and sell. So if we can learn to identify uptrends without those indicators, that's a pretty simple way to trade. If you find the whole Fibonacci thing a little confusing, this might be pretty easy to gravitate to. So the idea of this trading concept is you're going to try to trade the middle 80% of an impulse. You're purposely going to kind of skip the first 10% and the last 10%. I'll explain how that kind of works in a second here. 80% is still pretty good, so take it. So if a stock, let's say, is coming along pretty flat, and then it's doing its jiggity jag thing, and then let's say it starts to move up, and it does like its first little like checkup kind of thing. So this might be where we take notice of the stock. So the whole idea is about identifying the peaks and the valleys that happen. So this being a peak, this being a valley, or in other words, a high and a low. So as you go, you kind of want to mark your highs and lows. So we'll call this a low here because it was kind of flat, and then it came up and down. So as soon as you see this down strike, you can kind of put that mark there. So that would be considered a high. Then it comes down and inflexes back up. So that obviously is a low. So the first thing you want to identify is higher lows and higher highs. So this is a low and this is a low. There'll be a bunch more as you go up the chart, obviously. So as long as the next low is higher than the previous one, this theory is good to go. So we see that and we go, okay, cool. That's like, the first 10% of this big wave, hopefully. We're good with letting that go. We could have invested down here, whatever, no big deal. Goes up and down. Now we have like an indication that this is sort of an uptrend starting. So we can buy here. Let's say this is like our buy zone. So the stock kind of continues along. And as soon as it gets above the previous high, we can start considering that the next highest high. So it might go up, who knows how long, and let's say it breaks somewhere up here. So this is now considered the next high. So it's higher than the previous one. So that again confirms that this is an uptrend. We have two higher highs and two lower lows. And again, inside this, it's all jiggity jaggedy, really confusing. Just smooth it out and it makes it a little bit easier to see. What I would do here, and this is a way to protect yourself from the drops, as it goes up and makes every progressive higher low, you would set your stop loss or your alerts here. So let's say, we did buy here and we're up in this area here somewhere. I would set my stop loss down here. Let's say it's like, $5 or whatever. Mark that at 5. So I would say if it gets below $5, give me alert and I got to sell it and lose my money, or so I don't lose my money. So let me continue along. We make our next high. It comes this way and it kind of dips again and moves up one more level. So, it's definitely a low. You can say that for certain. So we're going to mark that, and it's a higher low than the previous one. So that's good. That continues to mark this as accurate, and it continues on in this uptrend when it passes the previous high of, this level across. So that's a good sign that it's still moving along. So I may have bought here, you never know, or you just original investment, up to you. But theoretically, you can buy anywhere along this line in this theory. You're still making money at the end of the day. So what we're going to look at next is if we get to this point here and the stock's continuing to rise, I'm pretty confident because now I've got a third higher low. I'm going to move my stop loss from down here to this spot here. Let's say it's like $10 or whatever, so it goes up here. And now if the stock, for whatever reason, makes this downturn, let's say it actually does do this in this example, and it comes down here, we're thinking, great, it's a higher high. We have 1, 2, 3 higher highs. That's in the right direction. I'm loving it. Great. We would make sure that our stop loss is set at our previous highest low, which is $10. So now the stock starts coming down, and as soon as it gets down here below our $10 marker, our alert goes off or our sell goes off on the trigger, and you cash out because this could now start doing one of these down. And this is really helpful. I know we bought in here, we cut our losses here. So this is kind of that like middle 80% of this first impulse wave that we just successfully traded. So then when it starts coming down, As soon as it breaks this area, this is that head and shoulders thing, if you know about it. The neck is broken, you would say here, so it's coming down through that stop loss, and it comes down. Now we have a low, a high, a low, and a high as we see. So as it's coming down, we now have a high, a lower high, a lower high. We have a low, a lower low, etc. So that's kind of reconfirming that everything's going down. And when it wants to switch impulses and go back the other way, like let's say up here, it's coming down like this, and then it does one of these. As soon as we see this low and this high here, when this high gets above this previous high, that's a switch of a low high to a higher high. And then we're pretty sure it's going to continue in that upward direction. All right, so that chart looks super insane. So let's switch over to a stock that we're all in, I think, and try to figure this out based on the pattern in front of us. I'll get rid of the volume too, just so it's easy to see. So this is NEO. We're looking at the daily chart. I know, pretty sure most of us are in this. So again, like I said, this is jiggity jaggedy. It's super scratchy and all over the place. Really hard to read looking at it, a little overwhelming. So with no indicators, let's mark this one out. So I'm just going to take the brush tool and just kind of like, maybe we'll do it with orange. Yeah. I'm just going to loosely draw over top of this, like what I think like the kind of general flow is. You could do this with the moving average. Actually, let's do it that way because that's really smooth. So let's grab the moving average. Again, you don't need to use this indicator. As I said, this can be done without indicators. But for argument's sake, this one will kind of smooth out some of the action a little bit and make it easier to see. So if I'm interested in this at the daily level, this is a 9-day moving average right now. We could probably make this shorter a little bit. Like let's say, let's see what like a 3-day average looks like. Yeah, a little bit more action so it's easier to track. So I mean, 20 or a 50 or a 200-day moving average, the line would be a lot smoother. You'd have to zoom out a whole bunch to see any real price action. So let's just take 3 just for argument's sake. So there's kind of a smoothness to the tops and bottoms that we can kind of see here. So we're also going to make this a little, let's make it thick so we can actually see it. And orange so it's easy to see. Okay, cool. So let's say that's kind of our, actually maybe the blue one's easier to see. I swear I kind of know what I'm doing. Blue, there. Okay, so this is our chart here, let's say. So let's kind of mark out some highs and lows using the brush tool. So it's kind of flat here. We've got, let's say this is like a high here, and then we've got a high peak here. We've got one here. We've got, I guess, yeah, like one there, one there. This is a high. This is a high. This is maybe a high here. And for argument's sake, we'll put one there. So that's kind of all the peaks, I guess. Like you can get really close and get really detailed if you want. You don't really have to, but let's just add another one there and maybe not really. Yeah, so, okay, so let's go with that. So let's call those the highs, and then let's mark some lows. So that looks like a low. This shelf is kind of a low. That's a low. This is kind of a low here. That's a low. That's a low. This looks like a low. I guess it down spikes a low, and then we switch. So I would say that's a low. This is maybe a low, that's a low, that's a low, low, and well, this kind of looks like a big low, I would say. Yeah, so now we kind of got an idea where our peaks and valleys all exist along the way. So let's see if we can kind of read this chart as we go across. What I see here is a high, a higher high, a higher high, a higher high, and a higher high. So if I see all that, I look to the lows, low, higher low, higher low, higher low, higher low, higher low. So all of this is just steadily confirming for me that we are in an uptrend. So, I might miss that first 10% around here. Let's say I get in, maybe here on this peak, this spike here kind of piques my interest. I buy in. So let's call this our buy zone in this area. So we're going across and it's continuing to follow all the rules. We're super pumped. This is great. We get up to here to our high, and then we're kind of expecting this as it comes down to check up at our low here. We want this to keep going up beyond our previous high, but it doesn't. It actually comes down. So that's okay. That's just indicating that it's going to go sideways or down. So what happens then is we get a high over here that's lower than this one. So you see it's kind of like, started to swoop down a little bit. So that might be a bit concerning. The first lower high is not like panic mode by any means, but maybe if you get 2 or 3 lower highs in a row, like if it wants to kind of like, keep breaking down, that might be, a spot where you'd want to, obviously jump ship. But one of them isn't really anything worth like, panicking over. So for this argument's sake, I personally wouldn't jump out on this theory. So as soon as it goes down, then you're also checking the lows. So we've got the low here. Our next low looks like it was here before it went up a little bit. So that's a lower low. And then the next one is a lower low than that one. So that's also evidence that we're in a downtrend. So that's 3 lower lows in a row. Maybe if I got that second lower high down here somewhere, I consider maybe pulling some money out, and that might be that top 10% that we're meant to miss. We would take our gains on this middle, sort of 80%. But what actually ends up happening is after our next low, instead of it continuing down, the price goes up and it goes above our previous lowest high. So that's kind of your first indicator, okay, maybe it's starting to go up again. Then we notice our next breakdown. It's a low here before it moves up. So that's a higher low here than it was here. So now we're getting the impression that it might be wanting to do this in this direction, kind of an idea. So it starts moving again. We get it's supposed to be orange, but anyway, we get a high here and a low here. So that's 1, 2, 3 higher lows in a row and 1, 2, 3 higher highs in a row. That's pretty good evidence that we're starting to move up. Maybe I'll just stay in with my position and keep riding it, which is what we've done. Or you could buy more here because this is also a consolidation technically because it's kind of going down and then up. So you're not quite sure, so let's move it up. Then it gets up to here. And this is kind of this last 2 weeks that we've been looking at. Basically, we've seen it get to its next high. Instead of seeing this low and then a bigger high, we've got this next high here that's lower than this one. So we're kind of going lower high a little bit here, but our lows, you'll see it hasn't given up this sort of level right along here. And this is, that 55 zone or whatever I was talking about in the chat. It's not giving up that level, so I'm treating that as like a big low. Until it breaks down below, then I have no real concern that it's going anywhere else. I think it's a sideways thing before its next move up. But again, if we were kind of applying the theory on this, our stop loss, we would put our indicator at our next highest low, I guess you would call it. So let's say we're up in this area here. Our next most recent low was this one right here. So as soon as we checked up and started moving up, we would move our stop loss right up behind it because it would slowly, our stop loss would start way down here, and our stop loss just kind of slowly follows the price action a little bit up to this spot here. Actually, technically, this stop loss pattern would never dip. It would just kind of go like that, unless you're cashing out, obviously. So it gets up to this spot up into here, and we would set our stop loss here. So let's say next week, whatever, the Neo president comes out and he's like a mass murderer or something like that. Stock just plummets. It would start falling down here. As soon as it passed this line, our stop loss, we would get our alert, 50 bucks, let's say, just for argument's sake. We cash out, take our money, and we're good. We've got this entire section of profit that we've gained. Oops, that's a lot, but that's all the profit that we're getting. That's how awesome this is. Basically, you're taking that middle 80% happily. If this reflects up, which is what I'm pretty sure we all expect it to do right now based on all of research, it's going to go up in that upward trend and we're not having to worry. But every minute chart, hour chart, daily chart, whatever, will show these higher lows and lower highs. It's just a matter of marking them out and just being able to read what they mean when they change. So that's naked trading theory. Hope that makes some sense and you find that useful.